Moving on now, though, with business news with Stephen Carroll. Good morning.
Hi, Catherine.
We're going to start off in France with the telecoms takeover that simply wasn't meant to be.
Yeah, this is to do with a company called Bouygues. It's France's third largest telecoms firm, and it's rejected a €10 billion takeover offer from Altice, which owns its rival SFR. The bid was rejected after the French government expressed concern over the impact the deal could have on consumers as well as jobs. Chief Executive Martin Bouygues says he thinks his company can survive alone. Phoebe Lanzer-Wood has more.
The deal that almost was. With a reported €10 billion cash offer on the table, telecoms giant Altice looks set to take over rival Bouygues. But the French government had expressed concerns that a merger could reduce competition in the market and lead to layoffs. In an effort to save the deal, Altice head Patrick Drahi held crunch talks with France's economy minister on Tuesday evening.
Listen, I can't tell you in detail what happened. There are things that are being worked on that need to move forward. That depends on several things.
But just minutes later, Bouygues Telecom issued this statement.
Bouygues' board of directors will not enter into negotiations with the Altice group.
During an interview with RTL Radio on Wednesday morning, the CEO of Bouygues said that politics was simply not a factor in the decision.
There wasn't any political pressure. I believe they left me the room to make the right choice. And in the end, it wasn't my choice. It was the board's choice. They met for 2 hours.
A deal would have reduced the number of telecoms companies in France from 4 to 3. That's in line with a shift towards consolidation in the European telecommunications sector. But Bouygues believes it can survive alone, despite being set to lose money again in the first half of this year.
Well, let's take a look at how the markets are reacting to that. And I can tell you the telecoms market here in France, all of the main companies involved are getting a bit of a hammering on the stock markets this morning. Bouygues down 7.85%. This is just after the open, I should point out. Altice down 6%. Numéricable SFR, which is one of Altice's companies, they're down over 11%. Iliad, which owns Free, another one of the operators, down 3% too. And Orange also seeing its shares trading down too. As you can see, nobody appears to be happy on the investor side anyway that this deal didn't go through. Let's take a look at how things are trading generally, though, on the European markets at the open. It's a more positive picture, as you can see the main European markets opening up. On the national front, I can tell you there's some good news for the French economy this morning as well. The National Statistics Office saying the economy actually grew by 0.1% in the last 3 months of 2014. Not zero growth, which was they previously registered. So every small improvement helps, I suppose, in that matter. Over in Asia as well, we had some optimism about the potential of a Greek debt deal helping shares across the Asian markets. As you can see, the Nikkei earlier hitting an 18-year high in trading. Of course, Japanese markets have generally been doing very well because of the government's and central bank's stimulus policies that bearing out on the stock market.
All right, well, speaking of that Greek debt deal that you just mentioned, it's been knocked off our main news agenda by the WikiLeaks revelations, of course, today. But negotiations and meetings still very much going on. The Eurozone's finance ministers are getting together today. The Greek Prime Minister, though, perhaps facing some more challenges closer to home.
Yeah, that's right. So while there's another crunch meeting happening in Europe over Greece, Greece's economy minister says there are just 2 or 3 points left between the two sides in the discussions over economic reforms. But whatever deal might be done, it's going to be a hard sell to many in the governing Syriza coalition. The current proposals include tax rises and raising the retirement age. The Financial Times is reporting that Germany has insisted the Greek parliament pass the reforms immediately once they're agreed at a European level. That could be very difficult for Prime Minister Alexis Tsipras. Many Syriza lawmakers opposing these changes. All of this, of course, as Athens is facing that €1.6 billion payment to the International Monetary Fund due on June 30th. Time is a-ticking.
Indeed, and all those people coming out to protest against more austerity in Athens, as we've been seeing.
Yes, exactly. We can expect that, I think, to continue in the coming days. In the meantime, though, let's take a look at some of the other business headlines today. Amazon is to stop selling merchandise that uses the Confederate flag in the United States. The decision follows the racially motivated attack at a church in South Carolina last week. Other retailers, including eBay and Walmart, have taken similar steps in taking products off the shelves over what they say is the flag becoming a contemporary symbol of racism and divisiveness. And there's change on the way at Boeing. The company's chief executive, Jim McInerney, is stepping down to be replaced by the current chief operating officer, Dennis Muilenburg. McInerney hands over the reins with a record order book for Boeing and the fastest aircraft manufacturing rate in its history.
All right, well, speaking of company bosses, it seems Monday was a particularly good day for one fashion mogul.
I'm terrible at Mondays, but apparently the man who owns Zara, Amancio Ortega is his name. He's the chief executive of Inditex. That's the company that owns Zara, a lot of other clothing brands. A jump in shares in his company of almost 4% on Monday made him a cool $2.3 billion.
That helps the start to the week, doesn't it?
Yeah, get me out of bed on a Monday morning. According to Bloomberg, his fortune has risen $11 billion so far in the first half of this year. That's to $72 billion. Not bad work for a Monday morning, I suppose.
Not bad work indeed. Thanks very much, Stephen Carroll, with the business news there.